All right, Chapter 21, Dispositions of Partnership Interests and Partnership Distributions. And so what we learn here is several things, and we start out by talking about just the basics. So let's get right to it. And so, as it points out, selling a partnership interest raises some unique questions that go back to our discussion of the entity approach versus the aggregate approach. And so when you sell a partnership interest, the question is, well, is my interest in the partnership separate from the underlying assets of the partnership? If so, then it's like stock in a corporation, owning stock in a corporation, and we simply figure out how much we realize, and from that we subtract our capital to come up with our capital interest and to come up with our gain or loss. If it's an aggregate approach, we have an interest in each asset of the partnership, and essentially the sale represents our sale in our aggregate interest in each asset of the partnership. For the most part, the law follows the entity approach, but in some instances where to take that entity approach would cause some unfairness, some advantage to the taxpayer and not to the IRS. And as you know by now, the rules are stacked in favor of the IRS for the most part. And so where they see that taxpayers are taking advantage of the situation, they'll use an aggregate approach in determining gain or loss. So we start with seller issues, and the primary concern is calculating the amount and the character of the gain or loss on the sale. And essentially it's like anything else, it's the amount realized minus the basis, outside basis in the partnership. And again, here we have this uniqueness of dealing with debts. And so if the selling partner, in their disposition of their ownership interest in the partnership also is relieved of debt, then that amount of debt relief increases their amount realized. So that's the one little catch. The other little catch is when, let's say that and again, when you sell partnership interests, it could be to other partners within the partnership, could be to someone outside the partnership, if it's allowed, or it could be back to selling back to the partnership. So a couple of different ways, 3 different ways you could do that. Anyway, so the general rule is the amount realized minus the partner's basis equals their gain or loss. Now, when you have a partnership with what they call hot assets, the rule changes. Well, what is a hot asset? Well, it's not your girlfriend, okay? It's unreal or boyfriend. It's unrealized receivables and let's see, depreciated property. So, well, we'll get to the depreciated property here in a minute. So unrealized receivables happen when you have a partnership that has a cash basis reporting. If they're accrual basis, you're not going to have unrealized receivables. Only when you have a cash basis partnership. And so what is an unrealized receivable? Well, it's any right to receive payment for goods or services either delivered or to be delivered. And so again, it only applies for unrealized receivables when you have a cash method partnership. Now, inventory items include, and again, why are we talking about this? Well, these are ordinary income assets. So if you have a partnership with these ordinary income assets, you know, normally the sale of a partnership interest would be a capital interest, so, you know, they have a capital gain or loss. But when you have ordinary income assets like this, these hot assets, a portion of that gain or loss will be attributable to hot assets, ordinary income assets. So you have to determine which is ordinary income and which is capital. And so that's why we're having to do this. Well, inventory items it's pretty broad. It includes classic inventory, property held for sale to customers in the ordinary course of business, but it also includes any assets that are not capital assets or assets used in a trade or a business, otherwise known as Section 1231 assets. And so what you do in a case where you're selling an interest, a partner is selling an interest in a partnership that has hot assets, the process for determining gain or loss is different. And so here are the steps. Step one, you figure out your total gain or loss by subtracting your outside basis. That's the seller's outside basis from the amount realized. Then what you do in step two is you calculate the partner's share of gain or loss from the hot assets as if the partnership sold these assets at fair market value. And so this represents the ordinary portion of the gain or loss. And then step three is figuring out the capital gain or loss, which is subtracting step two from step one. And so look at, for example, and you probably have to start with example 21-1. There you have this Chan's Inc. selling its 30% interest, and just kind of going by the general rule, the recognized gain, which is step one when you have hot assets, is $19,000. And so if you go to example 21-2, you note that at the time of the sale, this partnership has unrealized receivable of $13,000, and notice that we have what's called 1245 property. That's the equipment that's depreciated more than its fair market value. So you've got $6,000 there. It's the $86,000 minus the $80,000. So that would be considered inventory. I think they talk about that. Yeah. Unrealized on page 4, unrealized receivables also include items the partnership would treat as ordinary income if it sold the asset for its fair market value, such as depreciation recapture under 1245. And so that's, we haven't really talked about depreciation recapture under 1245 yet, but I mean, it's essentially the difference between straight line and your tax MACR's depreciation. When you sell it, you've got to look at recapturing some of that accelerated depreciation and treat it as ordinary income. And so that's what they're talking about there. And so here we have the basis, tax basis at 80,000, the fair market values at 86, which means that because of the MACR's depreciation, it's depreciating faster than its fair market values, what it boils down to. And so that is considered, for sake of these rules, inventory, because it's subject to ordinary income. So inventory is broader than just what you think of as inventory. And so if you look at example 21-4, it shows you the steps. We already figured out that gain realized is 19,000, and then they allocate between what's capital and what's ordinary. So make sure you understand that. Now, as far as buyer and partnership issues, basically the new investor steps inside the shoes of the old investor, the selling partner. And the new investor's outside basis, for the most part, will be equal to his cost in the partnership interest. Well, that makes sense. To the extent, well, and here's where it really gets to his inside basis, which is where he steps into the shoes, because the buying partner takes the selling partner's inside basis. Okay, as far as the outside basis goes, it's whatever he bought it for. And if the new investor shares in partnership liabilities, then that increases his or her outside basis. Now we have this thing called the varying interest rule, and essentially what that says is that if you've got the sale of a partnership interest in the middle of the year, any time other than its normal tax year, then you've got to consider that selling partner's interest increase or decrease as a result of what's happened during that year in which they sell the partnership interest. So you have to essentially bring up to date the books in that year that the partner sells his interest. So you have two ways of doing this, and that's that they can close the selling partner's interest in the partnership, income or loss during the year based upon some prorated amount. So let's say, just a simple, easy example, the partnership earns $200,000 during the year in which you have a selling partner, and the selling partner sells on July 1st. If you just prorated that, it would be $100,000, half a year's worth of income multiplied by whatever that partner's interest in that income is. Now, the second method would result in an interim closing of the partnership's books. Essentially, you would have a partnership short tax year for, well, really two years, two short tax years, pre-sale and post-sale. All right, so that was just kind of the basics of sale of a partnership interest. And so we kind of switch gears here, and we're going back to partnership distributions, operating distributions. So, the two subjects are somewhat unrelated because, we were talking about the sale of a partnership interest, and now we're not talking about the sale of a partnership interest. We're talking about partners going forward and, for whatever reason, receive distributions by the partnership, and the partnership continues to operate as normal. And so why does a partnership distribute operating income? Well, remember that partners are taxed on partnership income regardless of whether or not there's any cash distributed to the partners. So, without some distributions coming from the partnership to the partners, that would possibly put them into a cash crunch as far as taxes and maybe other bills as well. Now, when property is distributed from the partnership to the partners, remember they've already been taxed on this stuff. And so, for the most part, there's no gain or loss on the distribution of property to a partner, as long as it's an operating distribution, not a what we call liquidating distribution, where the partnership ceases to exist. Now, you have to distinguish between, just like we saw before, operating distributions that are of cash only versus operating distributions that are of cash and maybe other types of property, including hot assets. If the operating distribution is cash only, the partners generally do not recognize a gain or loss on the distribution of the property or money. They simply reduce their outside basis by the amount of the distribution. The one exception, of course, logically, is when the cash distribution is greater than a partner's outside basis. Then in that case, they're going to recognize a capital gain of the difference between the distribution and their outside basis. The excess would be capital gain. Note that you never recognize a loss on receipt of an operating distribution. And so the partner reduces their outside basis by the amount of the distribution. Of course, if the distribution's greater than the amount of their outside basis, they'd reduce their basis to zero, and then the excess of the difference between the distribution and their outside basis would be capital gain. Note that the partnership's basis in its remaining assets remain unchanged. What happens when you distribute property that's other than money, either with money, other property is distributed, or other property is distributed without money? Well, let's talk about, usually it's a mix, so let's talk about that situation. Essentially, they have to reallocate their outside basis to the distributed assets, including money, and their continuing partnership interests. The partner takes a basis in the distributed property equal to the partnership basis in the property where possible, assuming they have enough outside basis. And so you go through this ordering process to allocate outside basis to the bases of the distributed assets. And so when you receive cash and other property, first you're going to reduce your basis, your outside basis, by the money received, and then the remainder of the partner's outside basis is their outside basis. Now, what happens, and first it goes to money and then to the other assets. So that's assuming that you have enough outside basis to cover both money and then the carryover basis of the other property. Now, what happens when your outside basis is less than those two? Well, you're going to reduce your outside basis to zero, and whatever remaining basis you have after first allocating to money received goes to that other property. A good example would be example 21-13. And I think you may have to actually start with 21-10 and work your way up to 21-13. But looking at 21-13, you've got this Nicole receiving a distribution of $150,000 cash and investments with a fair market value of $100,000 and an adjusted basis of $90,000. Well, her outside basis is only $205,000. So she first reduces her outside basis by the amount of the cash distributed, $105,000. That leaves her only $55,000 of remaining outside basis. And of course, the basis of the investments was $90,000. So she's going to reduce her outside basis by that $55,000. So her basis after allocating remaining outside basis to the investments of $55,000 leaves her outside basis at 0. So make sure you look at that. All right, I think we're going to stop there, and tomorrow we'll talk about liquidating distributions and let's see what else we're going to talk about. I think that's about it. That should be enough. Yeah, we're just going to talk about liquidating distributions tomorrow.